Quote of the day. It's how you deal with failure that determines how you achieve success. David Fiaty. Welcome back, fellow investors, to another exciting episode of the Beginner's Guide to Smart Investments. Today, we're going to dive deep into an essential topic that every beginner investor should be aware of: the common mistakes to avoid in the world of investing. As a financial and credit analyst with years of experience, I've seen it all. I've witnessed both the triumphs and the pitfalls that investors face. And in this video, I'm here to ensure that you start your investing journey on the right foot, steering clear of the mistakes that can set you back. Mistake 1: neglecting research. We're kicking off our exploration of common investment mistakes with a big one: neglecting research. As a beginner investor, it's easy to be overwhelmed by the sheer volume of investment options out there. You might hear about a hot stock or a promising cryptocurrency and be tempted to jump right in. But let me tell you, investing without conducting proper research is like sailing a ship without a compass. It's risky, unpredictable, and can lead to unexpected obstacles. So, why is research so crucial, especially for beginners? Let's break it down. Point 1: informed decision-making. Firstly, conducting research empowers you to make informed decisions. When you thoroughly understand the investments you're considering, you can weigh the potential risks and rewards. You'll be better equipped to spot red flags, identify growth opportunities, and make choices that align with your financial goals. Point 2: risk mitigation. Secondly, research helps you mitigate risks. By digging into the details of an investment, you can assess its historical performance, track record, and potential pitfalls. This knowledge enables you to build a more resilient portfolio to market fluctuations and less susceptible to significant losses. So, how can you conduct effective research? It's not as daunting as it may seem. Here are some practical steps. Practical tips for research. Start by reading reputable financial news sources and market reports. Dive into company financials and annual reports. Explore investment forums and online communities for insights and discussions. Consider seeking guidance from financial advisors or mentors. Remember, research isn't a one-time thing, it's an ongoing process that should guide your investment decisions. So, there you have it with mistake 1, neglecting research. Avoid this pitfall by embracing the power of knowledge and conducting thorough research before making any investment moves. Mistake 2, emotional investing. Investing can be an emotional roller coaster. It's easy to get swept up in the excitement, fear, or even overconfidence that financial markets can evoke. But here's the thing: letting your emotions drive your investment decisions can lead to severe pitfalls. Let's explore why and how to avoid this common trap. Point 1: the psychology of investing. To understand why emotional investing is problematic, we must delve into the psychology of investing. As humans, our emotions often cloud our judgment. Fear might lead us to sell in a panic, and greed may drive us to chase unsustainable gains. These emotional reactions can result in impulsive decisions that harm our investment portfolios. It's essential to recognize and find ways to manage these emotional triggers. Point 2: real-life stories. Let's illustrate this with a real-life example. Imagine you invested in a stock that suddenly took a sharp dive. Panic sets in, and you decide to sell at a loss, fearing further decline. However, had you stayed calm and remembered your long-term strategy, you might have ridden out the dip, as the stock eventually rebounded. Emotions can lead to costly mistakes. Point 3: strategies to stay rational. So, how can you avoid the emotional investing trap? Here are some strategies to help you stay rational. Set clear investment goals and stick to them. Establish a diversified portfolio to spread risk. Create an emergency fund to ease financial stress during market downturns. Consider using tools like stop-loss orders to automate selling decisions based on predetermined criteria. Remember, it's perfectly normal to feel emotions in investing, but it's how you respond to them that matters. By staying disciplined, focusing on your long-term goals, and managing your emotions, you can make more rational investment decisions. Mistake 3: lack of diversification. As we journey through the common pitfalls of investing, mistake number 3 is a big one: lack of diversification. Diversification is like the safety net of investing. It's a crucial strategy that helps spread risk and protect your investments from turbulent market conditions. But what happens when you neglect it? Let's find out. Point 1: putting all eggs in one basket. The lack of diversification often involves putting all your eggs in one basket. This means investing all your money in a single asset, such as a single stock or asset class. While it may seem like a way to maximize returns, it's actually a high-risk move. If that asset takes a hit, your entire portfolio could suffer significant losses. Point 2: the power of diversification. On the other hand, diversification is the practice of spreading your investments across various assets. It's like having multiple safety nets instead of just one. By diversifying, you can potentially reduce the impact of poor-performing assets and cushion your portfolio during market downturns. Point 3: building a diversified portfolio. So, how can you avoid the mistake of a lack of diversification? It starts with building a diversified portfolio. Invest in different asset classes like stocks, bonds, and real estate. Within each asset class, consider a mix of assets with varying risk levels. Regularly rebalance your portfolio to maintain your desired asset allocation. Point 4: risk reduction. One of the primary benefits of diversification is risk reduction. By spreading your investments, you reduce the impact of a poor-performing asset on your overall portfolio. This strategy aligns with the timeless investment principle: don't put all your eggs in one basket. It's about safeguarding your financial future. So, remember, lack of diversification is a mistake you can easily avoid by building a well-balanced, diversified portfolio. It's one of the smartest moves you can make in your investment journey. Mistake 4: chasing hot trends. Have you ever been tempted to invest in something simply because it's the latest craze in the market? You're not alone. Many investors fall into this trap. But why is it a mistake, and how can you avoid it? Point 1: the temptation of hot trends. Chasing hot trends can be incredibly tempting. When you see a particular stock, cryptocurrency, or asset class skyrocketing in value, it's natural to want a piece of the action. However, the problem with hot trends is that they often come with a high level of speculation and hype. Point 2: the danger of speculation. Investing based solely on speculation and hype can be extremely risky. Prices can soar to unsustainable levels before crashing down just as quickly. This can lead to substantial losses for investors who bought in at the peak. Point 3: making informed decisions. So, how can you avoid the mistake of chasing hot trends? It all comes down to making informed decisions. Research thoroughly before investing in any trend. Consider the fundamentals, potential risks, and long-term prospects. Don't invest more than you can afford to lose. Diversify your portfolio to spread risk. Point 4: focusing on fundamentals. Instead of chasing trends, focus on fundamentals. Look for investments with underlying solid value, sustainable growth potential, and a proven track record. This approach can lead to more stable and rewarding investment decisions. In summary, while chasing hot trends may seem tempting, it's a risky investment strategy. Instead, focus on fundamentals, conduct thorough research, and make informed decisions to build a more secure financial future. Mistake 5. Neglecting risk management. Time to uncover the final common investment mistake: neglecting risk management. When it comes to investing, risk is an ever-present factor. It's not a matter of if, but when you'll face challenges. So, why is neglecting risk management a critical error, and how can you protect your investments? Point 1. The reality of investment risks. First, let's acknowledge the reality of investment risks. Every investment carries some level of risk. Whether it's market volatility, economic downturns, or unexpected events, risks are part of the game. Neglecting risk management is like venturing into a storm without an umbrella. Point 2. The importance of risk assessment. So, how can you navigate these risks? It starts with risk assessment. By understanding the potential risks associated with your investments, you can prepare and plan accordingly. Assessing risks involves evaluating factors like market conditions, economic indicators, and asset-specific risks. Point 3. Knowing your risk tolerance. Next, it's crucial to know your risk tolerance. This is your personal comfort level with risk and volatility. Are you willing to take on more risk for potentially higher returns, or do you prefer a more conservative approach? Understanding your risk tolerance helps you align your investments with your financial goals and emotional comfort. Point 4. Tools for risk management. To avoid the mistake of neglecting risk management, utilize tools and strategies like stop-loss orders: automatically sell assets if they reach a predetermined price. Asset allocation: diversify your portfolio to spread risk. Emergency fund: maintain cash reserves to handle unexpected financial challenges. Point 5. The role of insurance. Finally, don't overlook the role of insurance. Certain types of insurance, like life insurance or disability insurance, can provide additional protection for you and your loved ones in case of unforeseen events. By incorporating these risk management strategies into your investment approach, you can better safeguard your financial future. In conclusion, neglecting risk management is a mistake that can have dire consequences. Instead, embrace risk assessment, know your risk tolerance, and utilize tools like stop-loss orders and asset allocation to protect your investments. And there you have it all, 5 common mistakes that every beginner investor should steer clear of. Remember, the road to financial success is not without its challenges, but with the proper knowledge and strategies, you can avoid these pitfalls and pave your way to a prosperous future. Now, if you found this information valuable, don't forget to hit that like button, subscribe to our channel, and share this video with others who are embarking on their investment journey.